what's on the other side of this violent congestion zone is going to be even more dramatic and rapid than what occurred in the first couple months. So that's what I'm expecting. At that point, I think silver could be in that range of 300 to 500.
In conclusion, what we are witnessing is not a random series of disconnected market events, but the unfolding of a deeply structural transformation across the global financial system, one that is gradually but unmistakably shifting the balance of power, trust, and value itself, and at the center of this transformation lies a convergence of forces that can no longer be ignored: sovereign debt instability, weakening confidence in traditional safe haven assets like government bonds, the slow erosion of the petrodollar framework, the aggressive monetary responses from central banks, and the quiet but persistent accumulation of hard assets by the most informed players in the world. When you step back and look at the broader picture, it becomes clear that the volatility we see in gold and silver prices is not the signal, but the noise surrounding a much larger signal, which is the revaluation of tangible wealth in a world where financial promises are increasingly questioned, because for decades the system has relied on confidence rather than constraint, on expansion rather than discipline, and on the assumption that demand for fiat currency and government debt would remain infinite. Yet today that assumption is being tested as countries diversify reserves, reduce exposure to dollar-denominated assets, and prioritize sovereignty over convenience. And this is where the role of precious metals becomes critically important, not merely as speculative instruments, but as foundational assets that exist outside the liabilities of any single government or institution, which is precisely why central banks themselves continue to accumulate gold at a historic pace while retail investors, often driven by emotion and short-term price action, are shaken out during engineered volatility, creating a transfer of assets from weak hands to strong hands, from reactive participants to strategic accumulators. At the same time, the bond market, long considered the bedrock of financial stability, is showing signs of stress that cannot be easily dismissed, as rising yields in the face of central bank intervention suggest a diminishing appetite for sovereign debt, and this creates a dangerous feedback loop where governments must issue more debt to sustain spending, central banks must intervene to stabilize markets, and the currency itself becomes diluted in the process, leading to a gradual but persistent loss of purchasing power that may not always be reflected accurately in official inflation metrics, but is undeniably felt in the real economy through rising costs of living, energy, and essential goods, and this is further compounded by geopolitical tensions and supply chain disruptions that amplify inflationary pressures, particularly in commodities like oil, which, despite short-term fluctuations, remain structurally undervalued relative to historical norms and monetary expansion, suggesting that the broader commodity complex is in the early stages of a long-term repricing cycle. Meanwhile, equity markets present a deceptive calm, where periodic rallies mask underlying weakness in key sectors such as financials and credit, indicating that the system is not as resilient as headline indices might suggest. And this divergence between surface-level stability and underlying fragility is often a precursor to more significant adjustments, especially when combined with tightening credit conditions, over-leveraged commercial real estate, and weakening consumer balance sheets, all of which point toward a financial environment that is becoming increasingly sensitive to shocks, and in such an environment, the behavior of gold and silver becomes even more telling, because historically these metals have served as barometers of systemic stress, rising not in response to growth, but in response to instability, currency debasement, and loss of confidence. And what makes the current cycle particularly compelling is the potential for a more explosive and accelerated move, especially in silver, which has historically lagged gold before entering phases of rapid outperformance, often overshooting in the process as it attempts to realign with both monetary conditions and historical ratios. And when you consider the expansion of the money supply over the past decades, the relative undervaluation of silver compared to gold, and the structural demand driven by both industrial use and investment flows, the argument for significantly higher prices becomes less speculative and more mathematical, less emotional and more logical. However, it is crucial to understand that this is not simply about price targets or short-term gains, because focusing solely on price can lead to poor decision-making, especially in volatile markets where fear and greed dominate behavior. Instead, the real takeaway lies in understanding the role of these assets within a broader context of wealth preservation and systemic transition, because if the underlying drivers, debt expansion, monetary easing, declining trust in institutions, and the shift toward multipolar financial systems, remain intact, then the trajectory for tangible assets is supported regardless of interim corrections or engineered pullbacks. And this is why periods of volatility should not be viewed purely as risk, but also as opportunity, particularly for those who are able to separate emotion from analysis and maintain a long-term perspective. Ultimately, the global financial system appears to be moving toward a more fragmented and multipolar structure, where no single currency or institution holds absolute dominance, and where trust must be earned rather than assumed, and in such a world, assets that carry no counterparty risk and no political dependency become increasingly valuable. Not just as investments, but as anchors of stability, and while the transition may be gradual, marked by periods of uncertainty and resistance, the direction of change is becoming clearer with each passing cycle, as central banks, institutions, and informed investors position themselves accordingly, often ahead of public recognition. And this creates a dynamic where the majority may only realize the significance of these shifts after substantial moves have already occurred, reinforcing the importance of understanding the underlying fundamentals rather than reacting to surface-level narratives. So as you reflect on everything discussed, from the pressures in the bond market to the strategic behavior of central banks, from the evolving role of commodities to the potential for dramatic revaluation in precious metals, the key is not to predict every short-term movement, but to recognize the broader trend and position yourself with clarity and discipline, because in times of systemic change, those who rely on conventional assumptions often find themselves unprepared, while those who adapt to emerging realities are better equipped to navigate both risk and opportunity. And if you found value in this breakdown and want more deep, no-nonsense analysis on markets, macro trends, and the future of money, make sure you subscribe to the channel and stay connected for the next insights that could change how you see the financial world. In conclusion, everything we've explored throughout this discussion points toward one undeniable reality: the global financial system is not simply going through a temporary cycle of volatility, but rather undergoing a profound structural shift that is reshaping how value is stored, how trust is distributed, and how power is balanced across nations and markets. And when you step back and connect all the dots, from rising sovereign debt and weakening bond markets to the gradual erosion of the petrodollar system, from aggressive monetary expansion to the growing divergence between institutional behavior and retail sentiment, you begin to see a clear and consistent pattern emerging, one that suggests we are moving away from a system built purely on confidence and into one that increasingly demands tangible backing and real-world scarcity. For decades, the foundation of the modern financial system has rested on the assumption that governments could expand debt indefinitely, that central banks could intervene whenever necessary, and that investors would continue to absorb sovereign bonds without hesitation. But today that assumption is being challenged in real time as interest rates rise despite intervention, as demand for treasuries weakens, and as countries around the world begin to rethink their exposure to dollar-denominated assets, not out of hostility, but out of necessity and strategic self-preservation. And this is where the significance of gold and silver becomes impossible to ignore, because while paper assets rely on trust and policy, physical metals operate outside of that framework, offering a form of financial certainty in an increasingly uncertain world, which is precisely why central banks, the very institutions that issue fiat currency, are accumulating gold at a pace not seen in decades, signaling through their actions what they may not openly state, that the current system carries risks that cannot be fully mitigated through monetary policy alone. At the same time, the behavior of the broader market reveals a growing disconnect between perception and reality, where short-term price movements often mask long-term structural trends, and where retail participants, influenced by headlines and emotion, tend to react at precisely the wrong moments, selling into weakness and buying into strength, while institutional players quietly take the opposite side, accumulating during periods of fear and positioning themselves for the inevitable reversion that follows. And this dynamic creates a continuous transfer of wealth from the uninformed to the informed, reinforcing the importance of understanding not just what is happening, but why it is happening, because without that deeper perspective, it becomes nearly impossible to navigate the volatility without being consumed by it. Meanwhile, beneath the surface, The financial system itself is showing signs of strain that go far beyond daily market fluctuations, as credit conditions tighten, consumer debt pressures increase, and key sectors like commercial real estate and banking exhibit weakening momentum, all of which point toward a system that is becoming increasingly fragile, where stress in one area can quickly cascade into others, creating a chain reaction that central banks may struggle to contain without resorting to even more aggressive monetary measures. And this is where the concept of printing becomes central to the narrative, because in the face of a sovereign debt crisis, where governments themselves are the primary source of instability, the only viable short-term solution is often to expand the money supply, but while this may provide temporary relief, it inevitably comes at the cost of currency devaluation, eroding purchasing power and pushing investors toward assets that cannot be created out of thin air. And this is precisely why commodities, and precious metals in particular, are entering a phase of renewed relevance, not as speculative trades, but as strategic allocations in a world where financial repression and monetary expansion are becoming the norm rather than the exception. Within this context, the potential for gold and especially silver to experience more dramatic and accelerated price movements becomes increasingly plausible, because historically, silver has exhibited a tendency to lag behind gold before entering periods of explosive outperformance, often driven by a combination of monetary demand and industrial usage. Emphasize that the true value of understanding these dynamics lies not in chasing price targets or attempting to time every market move, but in recognizing the larger trend and aligning with it in a disciplined and rational manner, because focusing solely on price can lead to emotional decision-making, which is precisely what the market exploits, using volatility as a tool to shake out weak hands and redistribute assets. And this is why the ability to separate emotion from logic becomes one of the most critical skills in navigating the current environment, allowing you to remain grounded even as markets fluctuate and narratives shift, and to make decisions based on long-term fundamentals rather than short-term noise. As we look ahead, the likelihood of continued volatility across all asset classes remains high, with equities potentially experiencing periods of strength followed by deeper corrections, commodities undergoing repricing cycles influenced by both geopolitical and structural factors, and currencies facing ongoing pressure as central banks attempt to balance growth, inflation, and financial stability, all within a framework that is becoming increasingly complex and interconnected. And in such an environment, the traditional playbook may no longer apply in the same way it has in the past, requiring a more adaptive and informed approach that takes into account not just individual markets, and when you factor in the current levels of monetary expansion, the historical ratios between gold and silver, and the structural underpricing that has persisted for years, the argument for significantly higher valuations becomes rooted not in hype, but in mathematics and historical precedent, particularly when considering how previous cycles have unfolded, where extended periods of suppression were followed by rapid and often unexpected repricing events. And while it is impossible to predict exact price levels or timelines with certainty, the broader trajectory suggests that the moves ahead could be more vertical and more intense than what we have seen in the recent past, especially once broader public awareness catches up with what institutional players are already positioning for, because markets are ultimately driven not just by fundamentals, but by perception, and when perception shifts, it often does so quickly and with significant force. However, it is important to but the broader system as a whole. Ultimately, what we are witnessing is the early stages of a transition toward a more multipolar financial world, where reliance on a single reserve currency is gradually diminishing, where alternative payment systems and settlement mechanisms are being developed, and where trust is no longer centralized but distributed across a range of actors and assets. And while this transition may take years to fully unfold, the direction is becoming increasingly clear, as evidenced by the actions of central banks, the behavior of global markets, and the shifting strategies of nations seeking greater financial independence and resilience. And within this evolving landscape, the role of tangible assets, those that cannot be printed, manipulated, or easily devalued, becomes more significant, serving not just as investments, but as anchors of stability in an otherwise uncertain system. So as you take all of this into account, the key takeaway is not to be overwhelmed by the complexity of the situation, but to focus on the underlying principles that are driving it, to understand the forces at play, and to position yourself accordingly with clarity, patience, and discipline, because while the future may be uncertain, the trends shaping it are becoming increasingly visible, and those who take the time to understand them are far better equipped to navigate what lies ahead. And if you want to continue staying ahead of these shifts, gaining deeper insights into the markets, and understanding the forces that are shaping the future of money and investing, make sure you subscribe to the channel and stay connected for more in-depth analysis that cuts through the noise and focuses on what truly matters.